Right. Greetings, everyone, and of course, welcome back to accounting tutorials for you. May this year bring us nothing but multitudes of success in our academics. Today's lesson is basically based on grade 10 accounting. So we are introducing grade 10 accounting. That said, the two combined topics that we're dealing with today is your ethics and your GAAP. Ethics and your generally accepted accounting principles. Now let's go to the first term. What are your ethics? What is it that we understand about ethics? Um, Ethics is all about knowing what is right and what is wrong. Therefore, when you know that something is wrong, you are not supposed to do it. And of course, when you know that something is right, you are supposed to do it repetitively, isn't it? Right. Let's make a quick example as far as our ethics are concerned. So, to be precise here, we are speaking about business ethics, right? Doing what is right in the business. So when we are preparing our financial statements or our financial reports, we are supposed to be ethical at all times. What are the financial reports that we're speaking about? Our financial reports include, amongst others, a balance sheet statement, which is also called a statement of financial position. They also include an income statement, which is also called your statement of profit and loss and other comprehensive income. We also have another financial report or statement, which is called the statement of cash flows. We have your trial balance, and then we can go all the way to your pre-adjustment trial balance, post-adjustment trial balance, post-closing trial balance, and then and so on and so forth. So those are your financial reports or your financial statements. Now, when you are recording your financial information in those financial statements, you are supposed to be ethical at all times as the accountant of the business. What are the many cases or the few cases at which the accountant can be unethical when compiling financial reports? One of those situations, for example, would be one at which so the business, let's say the business has made a loss for the current financial year. The business made a loss of 20,000 rands, but in our income statement, our accountant says the business actually made a profit of 20,000. Now, not only is this a lie about our financial standing, but this also misleads our users of financial statements, in a sense that, remember, we have your investors, we have your lenders, we have your customers, we have your shareholders or your owners. So now, if our accountant says we made a profit whereas we made a loss, they are creating a false impression about the financial standing of our business. Lenders are going to be more keen to invest even more. The owner is going to be even more interested in investing more capital as well, because they believe that the business is actually doing well and it's actually lucrative. Whereas in this current year, the business actually did terribly. It made a loss of 20,000 rands. So misrepresenting financial information can cause, such ills in the business. And again, there's another situation that we can look at as far as our ethical conduct is concerned. Let us say now you are preparing your balance sheet statement, and now you are in your assets section. Now your total assets are actually worth 500,000 rands, but you lie in your total assets section. You say your assets are actually worth 800,000. Your assets are actually worth 500,000, but you are saying your total assets are worth 800,000. You have falsified your total assets. And as such, the investors, the lenders, the customers, and all the other stakeholders believe that you have so much assets, whereas rather you have so little assets. That causes a bit of confusion. That makes the users of your financial statement to make uninformed decisions because of the information that you have falsified. Right, and that's it with your ethics. Then we go now to our second key concept, which is your GAAP. GAAP stands for your generally accepted accounting principles, or your generally accepted accounting practices. Right. First and foremost, we are going to just mention them. All of them that we have here. We have quite a lot of them, around 10 or so, but I just decided for the purpose of this lesson, I decided to just go for just 5 of them. Then the rest of them, you are going to actually look at them on your own, right? So, the first principle is your going concern. Then the second principle, in no particular order, of course, is going to be your matching principle. Then our third principle is going to be your prudence principle. Then our fourth principle is our materiality principle. And then our last principle for this particular lesson is going to be your consistency principle. Let's go to your going concern principle firstly. Now, the assumption on your going concern principle is that the business is still going to be operational in the foreseeable future. In the next 3, 4, 5 years, the assumption is that the business will still continue to operate. That's your going concern principle. So whenever we are preparing our financial statements, we are making financial and business decisions, the assumption is that we are still going to be around in the next few years. That's your going concern principle. Then we have our matching principle. The matching principle now tells us that our expenses and income must be reported in the same year that they relate to. We have a financial year that starts in January 2025 until December 2025. Now, all the expenditure and the income that we are going to accumulate throughout this year must be reported this year in the statements of this year. It cannot be included in those of last year or in those of 2026. The income and expenditure that happens this year must be accounted for this year. That also speaks to your accrual principles, of which we are still going to talk about those. Our third principle for today is going to be your prudence principle. The prudence principle tells us that our accounting records must be based on facts and not speculation or assumptions. We cannot assume that since we made a profit last year, then this year we're making a profit as well. No, we cannot speculate or assume. We must use all the financial records that we have for this year. Then we can compile our financial statements. Then we can conclude whether we made a profit or we made a loss. Then we have our fourth principle for today, and this fourth principle is the principle of materiality or good faith. Now, through the principle of materiality, we are informed that accountants can ignore some rules if the amount in question is regarded or considered immaterial or too little or too insignificant. It's not gonna create too much discrepancies. It's not gonna